it is important to start considering whether there are options available to you that could give you a boost in your future savings or retirement plans, or simply help you prepare for your best financial future. One of the options you could consider is making additional voluntary contributions into your superannuation. For many people, their super savings will be the most valuable investment in retirement, next to their own home. As superannuation savings are taxed at a maximum rate of 15%, which is lower than the personal marginal tax rate for many, why not consider how you can give a boost to your super savings? If you are under 75 years of age and had less than $1.9 million in total super across all your entitlements at 30 June 2024, you can make voluntary after-tax contributions into super this financial year before 30 June. You can make an after-tax contribution of up to $120,000, or depending on what your balance was last 30 June, perhaps up to $360,000. Of course, not everyone can afford to do that much, and it's important to remember that even smaller amounts can be beneficial, as the low tax environment of super and having the amount invested over a longer period has the potential to generate a higher level of wealth. You might even qualify for some government super benefits, such as the government co-contribution or a low-income super tax offset, both of which go direct into your super fund. And if you can contribute to a spouse's account, you might also be entitled to a tax offset to reduce your future personal income tax bill. One of the options you could consider is making additional pre-tax contributions into your superannuation. Known as concessional contributions, you can make up to $30,000 of pre-tax contributions into your super this financial year. However, it is important to be aware of what makes up this total, as they can come from a range of different sources. This includes any contribution an employer makes to your super as a condition of your employment, such as the Superannuation Guarantee or SG contributions, and amounts you have selected to salary sacrifice as additional contributions. If the total of these amounts for this financial year will be less than $30,000, then you could consider making additional contributions to bring it closer to that $30,000 limit and potentially claim a tax deduction for that extra contribution. To claim the amount as a tax deduction, you'll need to complete some paperwork with your super fund, which is usually done after year end and must be done before you lodge your personal income tax return. And importantly though, if you were to transfer all or some of your super to a retirement pension or to a different super fund, you need to complete the paperwork before doing so. This is important because not doing this can actually lead to some or all of the deduction being denied. The contribution will still remain in the super fund, but will then count towards the level of non-concessional or after-tax contributions you have made. When it comes to making these extra contributions in your super in the lead up to the end of the financial year, timing is important. You shouldn't leave it until close to year end, as for the contribution to count for this financial year, it needs to be received by the super fund before 30 June. And depending on how you make the contribution, it could take a few days for the super fund to acknowledge its receipt. Every year, it is worth considering how your money has been invested and whether your current investment mix is right for you. You should think about this for investments both inside and outside super. But for today, let's talk about the investments you have inside super. Now, all investments carry some form of risk. For some, the risk is higher, such as investments via the share market, where the value of your investments can fluctuate up or down on a daily basis. But even conservative investments, such as cash and fixed interest investments, carry some risk, which might be that they won't generate sufficient returns for your future needs. While history has shown us that over time share markets trend upwards, which would have the impact of increasing your wealth over time, past performance is certainly no guarantee of future performance. What is truer, however, is that time in the market is better than trying to time the market. We can't predict when the value of investments will rise or fall, so trying to time when to change could give you a less than optimal result. But investing over the longer time can allow you to ride out any market fluctuations. What is key is deciding on what is the right investment mix for you. What's your right mix between growth investments like shares and managed funds and more conservative investments? Every year, it's worth considering what personal insurance you have in place. You should think about the type of cover you have, the amount you're covered for, and where the insurance policy is held. The most common type of personal insurance people have is life insurance or death cover. You may even have some default cover within your superannuation fund that you're not aware of. Now, this insurance can help your loved ones in the event of you passing, helping them to potentially pay off some debts such as the mortgage on the family home, or leaving some money to help them meet living costs into the future. You may also have some total and permanent disability or TPD insurance, again often held within super. Under this policy, an amount may be paid out to you in the event that you become totally or permanently disabled and are unable to work again in the role for which you are trained or educated. This amount again may help to pay off debts and provide for future living costs. A third policy you may have or could consider is income protection or salary continuance insurance. If you're unable to work temporarily, this policy can pay regular amounts to replace lost salary for an agreed period of time. Now, each year you should consider which policies you have in place and the amount of coverage you have. You should also do this as circumstances change in your life. At some points you might want to increase the level of coverage you have, and at others you might want to decrease it. The key is to ensure you do consider how much you have. If something was to happen, do you feel you and your family will be covered to meet whatever costs may arise? At BT, we believe it's important to help you prepare for your best financial future. Everyone is different and situations can change. This is why we recommend you speak with a professional financial advisor to work out what options are right for you.